VCTs and EIS are two very different beasts. They are grouped together because they are similar in a lot of ways in terms of they are venture, they're early stage. They have similar tax breaks up front, 30% income tax relief.
Free of capital gains.
Free of capital gains, which is very attractive.
The level of investment, I think
level
it's up
investment,
to 200,000
yeah, 200,000
VCT per annum.
Significantly higher, 1 to 2 million for knowledge intensive EIS investments. Venture capital trusts are, we would argue, probably more transparent as opposed to a blind investment with an EIS. EIS, you're investing, and obviously you're taking a punt on what it's going to do in the future. It's a blind investment, as it were. So you can look at the prospectus, you can look at the actual documents for the VCT and say, well, I know what I'm buying.
Yeah.
So actually, I can analyze it and I know what I'm buying. Yeah. That's a very different thing. So from a risk perspective, typically, your kind of three buckets, we would go VCTs first, as a relative lower risk. You have a strong typical dividend stream. Most pay out 5% per annum. And as you say, they are listed so you can see the price and you can trade them. Tax for the tax not to be reclaimed. Then in the 6th year, when you go to do another 200,000, you sell your first one, take that 200,000, roll it into the 6th one. So now you go from 30% tax relief to effectively 60% tax relief on the same pound. EIS are then a step up in risk.
I was blown away by one stat, which was the after-tax return of a VCT versus investing in public markets, or the pre-tax return, okay? So when I looked at that, I think broadly it was an average performing EIS or VCT fund, which basically have very similar tax advantages. But anyway, let's just say a 5-year cycle. And if it was performing at 2 times, for you to invest in the public market to get the same after-tax return, your fund manager would have to get a 5 times return to create the same equivalent after-tax position. That's an enormous difference. That's a hell of a return. And that's one of the most convincing arguments to have a part of your portfolio going into VCTs and to EIS.